Hey, Steve Saretsky here. Welcome back to the show. Before I get into this week's episode, I wanted to mention that the Loonie Hour, for any of you that's been following along that are in Toronto and you watch or enjoy listening to the Loonie Hour, we're going to be doing a live podcast in Toronto on Thursday, November 30th in Danforth. So again, if you're in the GTA area, highly encourage you to come check out our event. We're going to have a housing panel with Ron Butler, Daniel Foch, Jordan Skrinko. It's going to be moderated by Nick, who runs the Canadian Real Estate Podcast. This is going to be an awesome show. First drinks free. We provide appetizers. If you've ever seen any of the Loonie Hour live shows, we did, one in Vancouver here with 300 people this summer. The last one we did in Toronto was the Hockey Hall of Fame. These are like awesome events. It's not like your typical finance show that's, in a boring hotel conference room. These are really entertaining. That's how we try to keep them. So there's a link below to an Eventbrite page. So I would love to obviously see you guys there. I'd love to meet everybody. It's not a money-making thing for us. We're just there to ultimately build the Loonie Hour community and engage with everyone that watches these shows. So check that out. But for those of you who may have not noticed, obviously here in a different background, I'm actually just in Calgary, staying at the Alt Hotel, where I always do in Calgary. But actually just finished, for those of you guys that follow along, know that I invest in real estate predominantly here in Calgary, just finishing a fourplex earlier this year that's now rented out. And I just closed on my first land assembly in the same neighborhood, actually. So, closing on a third house, we'll eventually redevelop that into probably 18 to 24 townhouses, ideally keep those rental as well. So lots going on, always keeping busy, always trying to keep my feet on the ground in the housing markets and various housing markets, as we're seeing all these markets performing differently, right? I mean, obviously I do the bulk of my business in Vancouver. We cover Toronto quite a bit. I'm in Calgary. So just looking at how all these markets are performing, I think is important when you look at, the national housing figures, right? We just had the national housing data just came out for October. We saw sales up very, very slightly year over year. Overall, weak sales activity. One of the metrics that I think is worth noting is the sales to new listings ratio. Again, the number of sales compared to the number of new listings coming to market, and that fell to 49.5%. So that's actually a 10-year low. So the sales to new listings ratio hit a 10-year low across this country. Now, keep in mind, again, the bulk of the inventory increases that we're seeing is in Toronto. It's in the GTA, right? If you look at what's happening in, like I said, the Calgary market where I am versus the Toronto market, these markets have been going in different directions for the last 12 to 18 months. And again, you have to understand how these markets sort of play out, right? I mean, Calgary's a market that literally has been flat with no growth for the last 10 years up until, really the pandemic started. So very, very different dynamic than Toronto, for example. But on a whole, right, policymakers, particularly the central bank, they tend to set interest rates and monetary policy. They'll tell you they don't, but they really set it on sort of what's happening in national housing and when we say national housing, we don't just say they set policy based on housing. They set policy based on, consumers, consumer spending, how that plays into economic growth, GDP, inflation, of course, right? Like their whole goal is, hey, if we can squash the housing market, we can kill off demand, we can kill off borrowing, and that is going to slow demand and inflation. So, and that's exactly what they're doing. I think we're seeing this now. Again, if you look at the national housing figures here, you can see national house prices they are starting to roll back over. So they dropped, quite significantly during the onset of the rate hikes. Of course, we rebounded in the spring, and now once again, we're starting to roll back over. National house prices falling, I believe was 0.8% in the month of October, right? You start annualizing that, that's a pretty decent sized correction, right? It's 8 to 10% price correction on an annual basis. That is significant. If that happens for, let's say, 24 months, all of a sudden that's a pretty big national house price correction. So, and again, none of this should be surprising given where mortgage rates are. We've talked about this, right? Mortgage rates, while they're coming down a little bit in recent weeks, almost all mortgage terms today are still looking at a 6 in front of it. And and when you get a 6 in front of it, the numbers simply don't work. The prices have not adjusted to reflect that. And so you've got mortgage debt. The growth rate in mortgage debt in this country is running at its lowest levels since 2001. And so again, how are you going to sustain house prices if people aren't borrowing money to support the valuations? And so again, mortgage debt, the lowest since 2001. Household credit growth. So if you look at, borrowings outside of just mortgages, so household credit growth is now running at its lowest pace of growth since 1983. Now, this is a pretty precarious situation if you're a policymaker, particularly again if I'm, OSFI, or if I'm the federal government trying to get reelected, or if I'm the Bank of Canada, looking at the outlook and saying, this has the potential. I'm not saying it's happening, that it could continue over the next 6-12 months, but this has the potential to be a serious deleveraging event. And when people delever, right, what happens is they start paying down debt, and that is contractionary for the overall economy. And it's kind of counterintuitive, right? Because people think, well, you should save your money, pay off debt. That's not how our economic system is actually created. It's created on consumption and borrowing money and spurring credit growth to support economic growth. That's just the reality of what it is. And so we've got a situation right now where, if household credit growth collapses to its lowest level since 1983, it's hard to imagine how you're going to derive a lot of economic growth if nobody is borrowing money and spending money. And so we're starting to see this, right? I mean, we've had back-to-back quarters of essentially negative GDP growth, which is basically a technical recession. And you start adjusting for the rate of population growth, the rate of inflation. It's not a great outlook. And so this is something that David Rosenberg has recently flagged as well. He penned an article in the Financial Post, basically saying, listen, if mortgage rates stay more or less at these levels, by I believe it was 2026, you'd see 20% of national disposable income would be erased or eviscerated, as it is basically geared towards paying down higher interest rates on your mortgage. So again, 20% of national disposable income potentially coming off of the table. And so again, you're like, okay, well, there's a lot of narrative out there today. I think it's probably one of the most well heard of phrases that everybody keeps talking about is higher for longer, higher for longer, higher for longer. But how do you sustain inflation and economic growth? Again, if the economy is rolling over, people are now deleveraging, which, a deleveraging is a deflationary event. Deleveraging is deflationary. And so I'm struggling to see if this is the continued outcome that we're on, how that's going to be sustained. Now, again, it doesn't mean that you can't have a deflationary event and then reaccelerate into higher inflation 12, 24, 36 months from now. But if we continue on this current path that we're on, you have to think that's going to be deflationary. And it's interesting because at the same time we're talking about this, you look at Canada's producer price index. Producer prices basically pay. What are producers paying? And that's actually down close to 2.5% year over year. So producers are actually seeing deflation now on a year over year basis. Now, again, don't get me wrong, they've seen massive price inflation over the last 24 months, right? So, but if you look at it from a rate of change perspective, producer prices are 2.5% lower today than they were this time last year. So I think there's elements of deflation potentially coming into the system. Again, I'm not going to sit here and say, hey, inflation's completely gone and we can't be worried about it. But I think we have to understand that what is happening right now in the data. And you've kind of seen this in financial markets. We went from sort of the reflationary views of, 8 weeks ago to all of a sudden everyone's starting to price in this recession, bond yields coming off, oil prices falling rather significantly. And now all of a sudden everybody's starting to get worried about demand. And what I can tell you is I think we're seeing this in the housing market. Housing demand has been incredibly weak since September, in my view, and that's in Vancouver, it's in the GTA. We're getting some slowdown a little bit here in Calgary. And so this is starting to play out. And so you're seeing this. I can tell you what's happening anecdotally, right? Again, as someone that sells real estate in Vancouver, talking every single day with top producers all across the city. The one thing that we're seeing through and through from everybody is, okay, And this is how real estate markets tend to work, right? They're very slow moving. There's a lot of emotions involved. This isn't like hitting a button on the stock market and selling, 5 shares or 10 shares of your S&P 500. People are really emotional about the principal residence that they've, created a home in for the last 10 years, and they're now selling it. There's emotions, and they've, they are very sticky on their prices. And so what we're seeing is, okay, you go into like a listing presentation, and let's just say these are hypothetical numbers, but let's just say, the homeowner thinks their property is worth 1.5. I go in there, I say, you know what? Yeah, you were probably 1.5 in the spring, but market conditions are changing. I think you're probably about a 1.4 today. Well, I don't really like that number, so let's list it at 1.5. Okay. If that you're the boss, you're hiring me. I can only give you my professional advice. If you don't want to take it, then okay, we'll start at 1.5, and we're gonna probably have to have a discussion in 2 or 3 weeks from now about a price reduction, which ultimately I think is going to set you further back. But again, you're the boss. And so what happens is, again, they sit there at 1.5. 3-4 weeks later, you look at reducing from 1.5 down to 1.45. Again, you're still too high. You should have been at 1.4 to start. And what happens is, again, it sits there for another 3 or 4 weeks, and they go, okay, it's not selling. Take it. What do we do? And I say, well, remember when I told you it was 1.4? Well, you're probably more like 1.375 now. And so if you want to sell, we now got to reduce you to that 1.375, and we'll probably be able to move you. And they go, well, you know what? I don't really like that number. I don't like that number at all. Let's take it off the market. We're here in mid-November. Take it off the market, and let's try again in the spring, right? The spring typically brings better market conditions. Clearly the market's frozen. Nobody wants to buy. This is not a good time to sell. Take it off the market, try again in the spring. And that's what everybody is seemingly doing. Not everybody, but like good chunk of the market is now taking listings off the market for the year, and they'll come back on in January, February, March, when the new year turns a corner. And again, that's a risky bet, right? I don't know where prices are going to be 4 months, 5 months, 6 months from now. What I can tell you is right here over the next 2 to 3 months, I wouldn't expect a whole lot of things to change, right? Mortgage rates might slowly creep down. Sure, that might help a little bit, but in general, that's kind of the outlook. Now, I will put a little asterisk next to it, which is, sometimes these things are hard to predict, right? I think towards the end of 2022, right? Sales were at 20-year lows. Market sentiment was horrible. The idea was that things were only going to get worse in 2023. Listings were going to continue to stack up, and people were going to start foreclosing because they can't afford their mortgages, and prices will surely be lower in 2023. Well, again, calendar turned over into 2023. The spring market ripped. We saw, 5-10% price increase in Vancouver, large parts of Toronto, etc. And so that's surprising. And I think there's the idea that, well, hey, maybe that will happen again. Again, that's not really my base case. That's certainly not what we're telling clients to do. But that is the idea, right? Everybody is so trained in Canadian real estate that these corrections are often short-lived. And, if you can just stomach it, if you can just wait it out 6, 8, 12 months, 15 months, things will come back. And so again, this sort of seems to be the idea. And maybe that turns out to be a good play. Maybe it doesn't. But this is what people are doing. And so again, we can't change market conditions. We just have to accept for what they are. So what I can say right now is, as we head into next month, into December, I tend to find on the buy side to get better deals. You typically want to strike when sentiment is bad, and I can tell you right now, sentiment is bad. It's hard to negotiate when people see market conditions starting to change and they think things are going to get better. That's what we saw in the spring market, right? There was no negotiating because people saw, hey, rates are coming down, the market's picking up. Why would I take a low offer? What we're seeing right now is most low balls are being rejected, but 1 in every 15, 1 in every 20 is actually getting accepted. Because again, sentiment is so bad, a lot of properties are going no bid, that you can actually get away with a low ball if you find a motivated seller. So again, I hope that helps put things into context. Kind of worried about the macro here in Canada, given what's happening on the credit growth side, given what we're seeing on the housing side, and I think we're starting to see that recession trade finally filtering through into the market. So as always, we'll see you next week.